Okay, so I'm going to talk about my outlook for the year, and I really have two themes, like just to be really simple and really boil it down. We have basically the miners leading the metals, and over the last couple of months, I mean, since the last time I was here, we have a lot more evidence that that's happening, and building towards a breakout in 2018. Now, the breakout, you'll see on the charts, maybe it could come this year, but I'm kind of a little more conservative. I'm thinking that when we kind of get to the end of this year, then maybe that point forward could set up a much bigger year next year than this year. So starting off, we're talking about the miners leading the metals. I'm going to kind of start off backwards, talk about gold and the US dollar, then get to the stocks leading gold. And so this is a bear analog chart where I basically plot every bear market in gold, and I think this is, well, it's weekly data. Sometimes I show daily data, but this one is weekly data, and the current bear market is in black. And I mean, gold's really basically only had 5 bear markets, and 4 of them have been of this really long variety. The other one not in here was the 75 to 76 one. And if this long bear market that gold is in continues and we have another move down, I think what this chart shows that, I mean, if it continues, it's probably not going to continue for more than another year, I would say. Obviously, we never know. I mean, there's only 4 or 5 pieces of data here. But if the bear market in gold is going to continue and it's going to go down and test that 1050 level, it's probably not going to last for a while. Now, let's talk about the dollar. And in this analog chart, I plot the 3 bull markets in the dollar, and the current one is in black. And it may be difficult to see, but the dollar had this breakout from this pretty long consolidation. I mean, the dollar in the big picture still looks really bullish. It had this breakout, but it's coming back to retest the breakout around 100. It's possible it could correct a little bit more, even go as low as 97 and still be in really good shape. So I'm still looking for the dollar to have a big move higher. And as you can see, if that happens, that would be in line with history. And this is a big driver for the dollar right here, and it's really been driving markets for the last several years. And this is the dollar-yen chart. So if this chart is rising, that means the yen is getting weaker, the dollar is getting stronger. And as you can see, the dollar-yen chart has come up very close to trendline resistance, which dates back about 30 years. So this is something to keep in mind. Even though the yen is the second biggest currency in the dollar basket, the euro is the biggest and most important, the yen has still been really driving things, and that's why the dollar right now, in the very short term, it's declining, and that's because the yen is strengthening against the dollar. And that could continue for a little while longer, but this chart is setting up at some point for a potential massive breakout. So this dollar-yen, which is around 114 right now, eventually, if it gets above 120 or the low 120s, it could move quite a bit higher. So this is something that I'm watching, something to keep in mind for this year, because it's been a real driver. Now, if I'm right and the dollar would go a lot higher, of course, that would be negative for gold. But really, would it be that negative? Because looking at history here, because we're only in the third, dollar's only had 2 other bull markets. And you can see here with the dollar chart on top and gold at the bottom, gold has almost made double bottoms at the end of these dollar moves. And you can see going back to 82, 83, 85 there, that first one, gold made a low, and then gold's next low a couple of years later was only 5% below the previous low, so it's kind of a double bottom there. And yet, between those 2 points, the dollar rallied 37%. And the same thing happened, but a little bit to a lesser degree, in the late 90s, 2000, 2001, gold, it did make a double bottom there. It was actually up 1% compared to the bottom in 99, but at the same time, the dollar index went up 17%. So that tells us that even if I'm right and the dollar has this big move higher, maybe it goes up to 120 on the index. Certainly if that happens, gold would correct, but history is telling us gold maybe it makes a double bottom too, and it bottoms around 1050, or maybe it goes a little bit lower. So this is kind of the potential downside that we could be seeing in gold. In the big picture, of course, in the short term, over a couple months, gold would correct and go down. But looking at this big 30,000 foot view, as you can see, gold, it looks like there's a good chance it could double bottom if that happens. Now, these are intermarket charts. I love looking at ratio charts because bond yields, the dollar, the stock market, it can all drive gold in some way. So this is a big part of my work, looking at how gold is performing against other asset classes. And we know that recently gold has been strongly correlated to bonds and negatively correlated to interest rates. And one thing I'm watching for is to understand, when is that going to change? When, if rates are going up and inflation's really picking up, when is that going to be positive for gold? Well, one thing that can answer that is this ratio chart, gold against bonds here. I'm just charting gold against the long bond, the 30-year bond. And as you can see, that's kind of been consolidating. It's been basing for a while. It looks bullish to me now, actually, because it's above both the moving averages. And so that's something, if we see a big move higher and a big breakout in that ratio, that would be positive and tell us that gold is less impacted by rising interest rates than it has been recently. And then at the bottom is gold against foreign currencies. That's an ETF, which is basically the inverse of the dollar index. So that ETF is gold against a basket of euro, yen, Canadian dollar, British pound, Swiss franc, etc. And as we know, gold has been much stronger against foreign currencies. It actually bottomed at the very end of 2013. It's kind of been grinding higher. Recently it made a low right at the 80-week moving average. I use that moving average in all my work. And so this is something that is important to me in the kind of short term, because I want to see if this rally can go a little bit further. It doesn't have to quite get back to the highs, but can gold against foreign currencies move up a little bit more, because that would tell me that the December bottom there is probably going to hold. And so summing up this chart, we want to see gold performing well against bonds and performing well against foreign currencies, especially if we get into a point where the dollar is going to have a move higher again. Because if that happens, but gold is performing strong against these markets, that's a good sign. That tells us gold probably isn't going to go down that much. Okay, well, now we'll talk about the gold stocks leading, because they are, and this is something that's really been evident just the last couple months. We're looking at the juniors. I mean, the chart of GDX looks similar, but GDXJ and the juniors are actually a little bit stronger than the large miners. And this is a monthly candlestick chart, so every candle is a month's worth of action. And when you're looking at charts in the big picture, you really should look at daily, weekly, and monthly. And the monthly is more significant than the weekly, which is more significant than the daily, etc. So that's why, to get a real big picture view, I like looking at the monthly. And the moving averages in this chart are the 20-month, which is equivalent to the 80-week, and then the 400-day moving average. But we can see here the 20-month moving average. Look at GDXJ. It declined in December. It tested the moving average, but it rebounded and closed well above it. That's called a bullish hammer. It's a reversal candle, and that reversal is validated by the strength that you see this month in the strong white candle. Now, gold is different, because gold in November and December closed below the 20-month moving average, while GDXJ did not. And I kind of drew a line there to kind of compare levels. And so a key level for GDXJ is kind of around 30 or 31. GDXJ has rallied well above that, whereas a similar level for gold is right around 1220. So gold is still below that. Basically, I was looking at these charts very carefully last night, and where gold should be based on where GDXJ is probably 1250, 1260. Another way to put that is we could say that the stocks right now are trading as if gold is 1250 or 1260. But in any event, it's just a really good sign that we see GDXJ bouncing off that support. and having 2 bullish months consecutively while gold is still below the resistance at 1220 and still below the 20-month moving average, although it's kind of battling it right now. This is a weekly chart. We have the 80-week moving average, GDXJ on top, GDXJ below. And just look at the 80-week moving average and how perfect it is for GDX. I mean, during the bear market, GDX rallied up to it 3 or 4 times, failed every time. As we know, early last year, the miners exploded well above this moving average. And the recent low, they actually went below it for like less than a week. So we kind of had like a false breakdown, it looked like. And the same thing actually happened January 19th last year when the miners made a false new low for a day. It was called the bear trap, and then they had a big rally. And so we've kind of seen something similar with this recent low because the miners, they went below the moving average just by a little bit, but then as soon as that stopped, they exploded over the next couple of weeks. And I mean, in the bigger picture, looking at these patterns, I mean, you guys are probably familiar with a head and shoulders bottoming pattern where you essentially have 3 lows, and the first one and the last one are kind of similar, but the middle one, the head, is the lowest. And so over the last 3-4 years, it's possible that the miners have kind of been forming what's called a complex head and shoulders bottom, but I would call it a really complex head and shoulders bottom. But in any event, if we can see the miners get above the resistance and break out of these patterns, they're going to have a massive move higher. But the negative in the near term is that there's a lot of resistance. I've drawn the lines there. There's a lot of resistance that the miners have to deal with. And you can see in GDX, a lot of that resistance is 26, 27, and then the highs, which are a little bit higher. Similarly, for GDXJ, that resistance is around 41, 42. So on this rebound that we're having, I don't think we're going to get above those levels. I think it's going to take some time. It's going to take most of this year for the miners to really back and fill and chew through that resistance, chew through that supply and selling. But eventually, once they get above that and they get near the highs and they test the highs, they're going to be in position for a fantastic breakout and a huge move higher. But like I said, the way things are setting up now, I think that move is more likely to happen or likely to start at the very end of this year or early next year, and that sets up next year being a better year than this year. And you can actually see a similar pattern in gold, although the pattern is weaker because gold kind of has declining tops, whereas with the miners, they were able to make a slight new high at the recent peak. For gold, if it can get above 1375, then it's broken out of its bottoming pattern, and that projects to a target of 1600. Now, 1550 is also a key level. I mean, that's where gold broke down in early 2013. So, but the miners are leading, and I think the miners will eventually break out first. But that's what justifies this huge move higher that we could have next year. It's basically the miners anticipating gold breaking above 1375 and having that move towards 1550, 1600. And just in the kind of near term or medium term, this is another very positive thing for the stocks. It shows that their trend is fairly strong, I should say, just the underlying internals. And this is the advanced decline line, which is really, it's a breadth indicator, but it's really the holy grail of leading indicators. And so GDX is at the bottom. The advanced decline line is on top. The AD line made a positive divergence a little more than a year ago, which you can see November, December 2015. And we're seeing something a little bit similar now where the AD line recently was trading close to a 4-month high, call it a 3.5-month high. And obviously GDX is not quite at the same levels. GDX has not been able to get above its October, November highs. In addition, GDX retraced about 62% of that huge move that we had, whereas the advanced decline line only retraced 38%. So this just, generally speaking, I mean, this doesn't mean that the miners are going to have this huge move forward next week or even next month, but it just tells us that the underlying strength in the miners is strong. I mean, this is what we want to see at this point. So this is a good sign for the miners. And Stock Charts doesn't have this data for GDXJ, but I'd love to see it. I might put it together at some point. And we're going to end with some analog charts. And so in this chart, I'm comparing the Huey Gold Bugs Index. The current move is in black. As you can see, the other two moves from the 2000 low, 2008 low, those are in red and blue. And it's interesting because a couple months ago, I was worried because the correction that we had gone too far. It had went past the other corrections. But looking at this chart, I mean, it tells us that, I mean, there's so many charts and data, it really comes down to how you interpret it. And so looking at these other things, now it tells me, these analog charts, they tell me that, this is actually, in the big picture, it's a good buying opportunity because the current bull market is on the low end compared to the other bulls, whereas 6-7 months ago, you could see the black line there in July, it was well above everything else. So this is something, it can kind of, in that vein, it can serve as an overbought, oversold indicator. And so generally in the big picture, it does tell us this is a pretty good buying opportunity. And this is probably my favorite of all the analog charts. This is a junior gold index that I constructed, and I've changed the companies in it several times. But the black line is currently where we are now, the current bull. The red is 2008 to 2011, and then the blue is 2001 to 2007. And in the middle there in 2004, I added or replaced it with a basket of silver stocks, and you can see that line ended up going up quite a bit higher compared to the other line, which only went up 33 times. And the companies in my index right now, the market cap, the median market cap is probably around 500 million, 550 US. It's probably a little bit big. I mean, I should look at constructing an index of smaller companies. But the point is, if we are in a new bull market, as we all believe, then, I mean, there's a lot of room for this to run. I mean, in my last couple presentations here, I talked about the low we had a year ago, the greatest buying opportunity of all time in gold stocks. I mean, they were basically, any way you wanted to measure them, they were trading at like a 90-year low. Worst bear market in 90 years. Gold stocks against the stock market, lowest ratio in 90 years. Gold stocks against gold, lowest ratio in 90 years. So from that point, we're just going to have fabulous returns over the next 5, 10, probably even 12, 15 years. But, I mean, as you can see, there will be big pullbacks along the way. And I think that after the big pullback we had, this is probably more likely to follow the 2001 to 2007 bull, simply because with that bull, that tended to have massive moves higher, massive moves higher, but also periods of consolidation and then a couple of big corrections, 45 to 50% corrections in there. And we can see we just had about a 45% correction, and we've rallied a little bit. And this is a chart of an index of all the companies here. It's weighted equally. This is in Canadian dollars. All my other charts are in US dollars, but this is in Canadian dollars. And as we can see, this index went up 200%. That it had a pretty big correction, but it did bottom above my favorite moving average, the 400-day moving average. As you can see, it went above it early last year. Then it went above it, or it held above it in recent months. And kind of in the short term, you can see it could go up a little bit more, and there's resistance there. So kind of my short-term outlook over the next couple weeks, I think we have a little bit more upside then we're probably going to see a period of weakness for a couple months after that. I mean, at the next conference in May, we'll see where things are trading. I'm going to say I expect that we're not going to be if I had to guess, I'd say I think we're going to be trading around these levels or maybe a little bit lower. So that would be my guess, that we're probably going to see a better buying opportunity in the next couple months. But generally speaking, in the very big picture, where we are right now, if you can hold for several years, I mean, it is going to be a great buying opportunity. And for anyone who here wants to subscribe to my work or learn more, you can send me an email. Thanks so much, everybody. I think I went a minute over my time, so we're going to end it there. Thanks a lot, everyone.